David R. Guttery is an investment advisory representative of Emeritus Investment Corporation and president of Keystone Financial Group in Trussville, Alabama. Please stay tuned through the end of the video for additional important disclosure information.
Clients and friends, as you're aware, global markets are in a state of fluctuation. Markets don't like shocks, and we've had two of them in recent months. China was late in telling the world about coronavirus. As it was spreading, we didn't know how virulent it might be, the incubation period, the fatality rate, or if conventional methods would be sufficient to treat the disease. The visceral response from world governments to contain and quarantine were of concern as a function of impediments to chains of supply. Markets also absorbed a shock when the Saudi Arabian OPEC delegation announced that it would defy the majority will of the OPEC cartel and produce at maximum capacity and artificially low prices. The price of oil dropped 27% overnight as a result, and that reverberated throughout the world's markets. Simply put, markets have had to absorb and react to a few substantial shocks that materialized quickly. Most recently, markets have had to absorb and react to significant measures taken by the Federal Reserve and the Treasury in efforts to underpin the economy that are being taken at the present time. The airline, cruise ship, entertainment, and restaurant industries are complying with the mandates of the World Health Organization and Centers for Disease Control to practice social distancing, and in some cases, ceasing operations entirely for a brief period of time. Markets are discounting mechanisms. Every minute of every day, markets are taking currently available information and pricing that into themselves as a function of anticipated outcomes. At the end of last year, markets made assumptions about the coming year in terms of productivity, profitability, earnings, and revenue. When travel bans, quarantines, and social distancing moratoriums are thrown into the equation, resulting from efforts to contain a virus that was previously unknown, markets will reprice the risk of previous assumptions. Impediments to chains of supply and how that might negatively impact levels of productivity and thus earnings and revenue and profitability are causing much of the volatility. Concern over such resulting in a recession to some degree is also contributing to the volatility. To give you an example, hypothetically speaking, on the 1st of January, markets may have assumed that company ABC was worth $300 a share. But today, if that company is reliant upon a factory in China, where workers have been quarantined for several weeks, then the market will reprice that risk, assuming that such a disruption in supply will negatively impact the company. Maybe the market reprices that stock at $200 per share as a result. That's a broad overview of why sudden shocks can cause markets to aggressively reprice risk and result in dramatic valuation swings. But if you think about it, it's a logical process. It is logical that the markets would adjust previous assumptions when current conditions change. Sometimes, however, the response can seem to be disproportionate. This is where we have to take a step back and be mindful of the empirical data. It is important to understand that markets aren't reacting so much to the disease as much as they are reacting to the reaction to the disease. I would recommend that everyone visit worldometers.info/coronavirus. This site pulls data from the World Health Organization and the CDC, and I would suggest that everyone pay particular attention to the global figures. We don't have time to get into the granular detail here. I can tell you that in China, the epicenter of the disease, the logarithmic graph of new cases has plunged almost back to the x-axis. The bar graph clearly shows the peak of new cases occurring around the 13th of February. Today, newly reported cases barely register. The nation of China has 1.387 billion inhabitants. I'm no physician, but I can read charts and graphs, and it seems to suggest that coronavirus has nearly run its course in the epicenter country. Indeed, on Friday, Treasury Secretary Steve Mnuchin said, quote, "China is open for business," and Apple announced that all stores in China would open again. If the market reacted viscerally to the fear over how quarantines and travel bans to that part of the world might impact chains of supply, and priced in the assumption of a long-term disruption to those chains of supply, but in reality, what we're seeing is workers recovering and getting back to work and manufacturing activity ramping up again, it stands to reason that the markets may once again have to reprice the risk of a worst-case assumption that a disproportionate reaction was potentially priced into the market. Look, we've seen other periods of time when markets climbed a wall of worry over things that never materialized. It's possible that we are climbing a similar, but much taller wall this time. We believe that at all times, but especially in times of crisis, that you lead from the front. We are investing many hours engaging our clients in conversation across a myriad of channels. I am absorbing every source of input that I can find about the subject provided by economists, fund managers, and analysts. I'm taking the information, assimilating it, marrying it with my own convictions, and we're staying in constant contact with our clients. Last week alone, my staff and I logged nearly 100 cumulative man-hours engaged in conversation over the phone. At times like these, a human voice is preferable to an email. We are also leveraging email and conference call technology, however, to reach as many people as we can. The advice is to remain convicted to the objective-driven strategy that we've placed into force. These plans were never a function of being in the market on the up days or out of the market on the down days. These were strategies based on assumptions to achieve an objective over a given period of time, and that remains intact. For those who find themselves later in life, who are more income-centric, with a capital preservation objective, you're likely not participating to any great degree in this market volatility. For those with an investment strategy that calls for the assumption of growth level risk and have an objective that may be 20 years into the future, I'm advising that an opportunity exists to make this period of time work for your benefit. It all depends on the DNA of who you are, your objectives, and the strategies that we've placed into a force to achieve these objectives. Let me ask you, where were you 20 years ago? Do you remember Y2K and all of the market angst that surrounded that period of time? To what degree do you believe that Y2K was still on the mind of the market as it was establishing a new all-time high on the 12th of February? 20 years from now, coronavirus will too be a distant memory. We will have something else with which to worry at that time. What you do today, though, could make a substantial difference in the end result with which you're left 20 years from now. In general, consider the opportunity that you have to dollar cost average and acquire greater numbers of shares at lower prices with static investments. In my opinion, we do have a disproportionate dislocation in the market, occurring against a backdrop of very strong economic metrics. No one knows when that environment will change. What I do know is that in order to have the opportunity to benefit when markets eventually reprice risk again, you must be in the market when that happens. I also know that we will get through this, and we will get through it together. Lastly, we are hosting a series of daily conference calls at 3:30 p.m. Central Time. To join the call, please visit our website or our social media websites for the dial-in metrics. Thank you for your time.
David R. Guttery independently offers securities and investment advisory services through Emeritus Investment Corporation, member FINRA and SIPC. AIC and Keystone Financial Group are not affiliated. Additional products and services may be available through David R. Guttery or Keystone Financial Group that are not offered through AIC. Some of the products and concepts discussed have their own cost and are subject to risk, including the possible loss of principal. These costs and risk will be thoroughly discussed with you prior to any recommendation or solicitation. Past performance is no guarantee of future results. Information provided is gathered from sources believed to be reliable. However, we cannot guarantee their accuracy.